All right, everybody. Good morning. Welcome to day three. We're going to talk a little bit stock, crypto, retirement, 10-year treasury as usual. I know we're going to start out with the credit card debt. It was kind of the focus of everything and where we started. So right here is this chart. And if you really zoom out, you can see the data points of credit card debt, right? Going up into 07, 08, we had all-time high of credit card debt. Now, this timed with the housing collapse. So now you had credit card debt plus people underwater on their mortgages, things like that. That's what triggered this. And as everybody then went to cash, look how long it took to clear that backlog. It took almost 5 years to clear that backlog. Then, like always, we started to do it again and get ourselves back up there right until about 19. Now, we were on our way down before COVID anyway. Like that correction was technically happening. And then because of COVID, credit card usage stopped and everything else there. Like we were headed towards something anyway. COVID made it a very exaggerated drop. And then just like that, look where we are. Now we're at, uncharted territory. Again, partly because the cost of goods is so much higher, right? If you're buying things now, the reason why we're always going to make new highs, not because more people are using it, but to kind of exponentially as things cost more than they did back in 07, 08. So you're going to have that higher credit card debt. So this is where we're at in terms of credit card debt. We're like a pin waiting to pop what's going on here. And now I just want to do a brief overview. Like I do a lot of videos like this with technical analysis, things like that, because the market always flashes signals before it does something. Besides like a COVID, very rarely is it just going to happen like that. There's always data coming out and people are making decisions, and people in the know are also making decisions first. I mean, technical analysis works because of insider trading, right? I mean, if someone in, say, Congress knows what's going on and something's going to get approved or not approved, and that information's somehow shared, those people take actions before the information's public. And those actions are seen in the charts. And that's why we can base a lot on charts, because it's human nature. This will always happen. This will always be a pattern that we see in life. So that's where I base a lot of the technical analysis on, just reading these charts and seeing what the data is saying, not what the people are saying. Because what the people are saying is never true. It's what the data is showing. So here's where we are with credit card debt. So when they say our economy is strong and we're worried about inflation, which is what they're doing right now, this is not a strong economy. This is, you take away credit cards, we don't have an economy, right? This is where we are. This is what we're spending. This is not a strong economy. You say that to the people, but then if you really look, is this considered strong? So that's why you say, you look at what you see and not so much what you hear. So when I always went back to the crash in 2007, 2008, later on, because at that time I was already a cop, I thankfully had a steady job. We were close to like being on hold, but that was a big part of like me looking into, when I just got my real estate license, I knew I wanted to do some investing and looking into these old economic charts, right? They have them for everything. There's unemployment, there's GDP, so once you started seeing, like, I remember there's one side, I wish I could find it. It had all the economic charts laid out. And when you looked at them, you're like, oh God, this was definitely coming. You could see it. But at that time, I was 24, 25 years old, wasn't really paying attention too much to the market. Now, different story. And I'm seeing things and feeling things. And that is more important than anything. What you see and feel is more important than what you hear, right? You have to make your own decisions. So in 07, 08, the signs were there. There's always some sort of lead up. But the data, the unemployment, the inflation, the advancing and declining, certain things can happen, but they don't actually look like they're not telling the truth, right? And that's what we're going to go through a little bit today. So here's our credit card debt. We talked about this. Not good. Let's flip over to unemployment. So unemployment, same thing. This was after the tech bubble, which I was 18 years old. I remember of it, but I don't really understand it. But same sort of concept. Look, and this was a longer stretch of unemployment. You're talking, beginning of the 90s. That was coming. All the unemployment was coming down from here. So, but that was a huge run up into the early 90s. Then you had the tech boom, same thing. Unemployment skyrockets, and then we fly into 08. And again, a huge number of unemployed compared to previous years. And this was a backlog. This took from 10 to almost where we are now. I mean, it was slowly declining, but this took a long time to clear, right? Then we had COVID, which was this one big spike, and then instantly back to where we were. If you look here, because these are subtle changes, it's finally starting to, these upticks, besides COVID, are usually slow, right? They just kind of level out, and then the data is always the data is always going to be lagging, and then the way they count the data, you can't even trust it 100% of the time, because they count, like, in some of them, what jobs were posted but not, and then who's on unemployment, who's asking for unemployment. But reality is, you see these numbers. If you know anybody in the job market now, it's not as easy as it was. So this is starting to tick up the other way, and that's how it usually works. It'll be a slow couple of months, and then it'll skyrocket when that data starts showing. So this is our unemployment, just slowly at the beginning starting to turn up, right? We're going to make another chart, because this is all relative here. This is a hard one to see for you. I'm going to try to make my chart. I don't want to mess around with the colors here, but basically I'll zoom in so you can see it. The important lines here are not so much the up and down. It's these two moving averages, which is what I have my own little indicator of what stocks are advancing and declining, right? So throughout history, when you cross above this line, you got more stocks on average over a certain amount of time increasing and making new highs and advancing over declining. When this is up and above this line, it's usually a healthy market. More stocks are advancing than declining. The general stock market in general is moving up. When you cross into the negative, usually means more stocks are declining, which will tie into like mini recessions or just pullbacks in the market that are sustained, usually more than 3 months, will start to show. But a healthy market is this, right? This is bouncing a little bit up, comes back to the line, a little bit under, back up, a little bit under. But like clear crossings to the downside, like we just had in October. October, we crossed to the negative, never made it back over, and we've been slowly more stocks declining than advancing on average since October. Now, why that matters is because it's going to happen, but when it's more significant is when you're looking at a stock market like this. You have at that point, let's go over here. We had a stock market making new highs, but it's making new highs, all-time highs, right? All-time highs, with more stocks declining than they are advancing. And that's when you start to say, well, all right, well, the stock market's looking great, but what's pushing it? Because more stocks are declining than advancing. So you were throwing a lot. The market is weighted, so a lot of it was coming behind a few big stocks holding up the market. Your Tesla, your Amazon, your Google, these guys are holding up the market. They're the ones making the new highs. But if you look at the average of the other stocks, there are more on average stocks declining on a day-to-day than advancing. And that is typical of change, some sort of change coming. And it's usually about 3 to 4 months out from what I've seen. I went back to, if we can go, I'll show you here, going back to 2020. So I made all the crossings just so you don't have to see it. But all the crossings back to 2020 in February. Here we go. We had a crossing in February of 20. We had a crossing where all of a sudden, for the averages were now more stocks declining than advancing. February of 2020. And then look what we had. A run up where we're making all-time highs, but not sustainable, and then into that COVID crash, which was coming anyway. It just was accelerated, I think, with COVID. But February 20, now we had an upturn on 5/20. So we're shooting over into May of 20, and we had our first upturn. I'm not paying for that. You get the ads. I'm not paying for this. May 20th, we had a first upturn, which meant now more stocks advancing than declining while we were here. And look at the trend that we ended up going. Didn't change until July of 21. Again, July of 21 had another crossing to the downside. And same thing, making new highs. This one went on even longer. This one went on a few months. But at this point, there was still more stocks. That line stayed negative this whole entire way. So more stocks were declining than advancing for months. And it's hidden in the charts because you look at the overall market, you're like, this is great. wasn't there. And then we finally peaked out in December of 21, and that's when the downtrend started. And that went, so we didn't have an uptick until July of 22. And here's where we were finally starting to see more stocks trending up than down. Again, these are not like right away indicators. It's just showing some momentum. So it took a little bit of time before it actually panned back out. But we didn't have another crossing. We were basically up since then until this decline over here, which is just recently. So now, same sort of story. We had a declining. The cues are a little cleaner. We had a declining advanced decline while stocks are making new highs. Not a great sign. I'm not a stock expert. I'm not a hey buy. It depends on your strategy and what you're doing. But if you're in need of that money, whether it's Bitcoin or some sort of retirement that you're planning on retiring soon, like it's time to get a little bit. It's time to be a little bit more conservative now, right? You can only do what you can do. You can't predict everything, but you stack probabilities in your favor. And if I zoom out to show you this, I don't know how you feel about like where do you want to be in a market like this, probability wise, right? We'll go out and make it even scarier. If we go out to a weekly, where do you want to be buying in a market like this? So perspective here, same thing. This looks a lot like that 10-year credit card debt, which it's great that we're actually investing this time. That's usually not the case, but we'll zip down to like a Bitcoin. Same sort of thing. I can't predict what's going where, but let's put some probabilities in our favor that we are in a move that we're extended and there's probably a time for a break. And that's what, just keep in perspective where your investments are, what you need it for. When your time frame is 10 plus years, it doesn't really matter. I mean, this will always, for the most part, the chart's there. It will always correct itself at some point. It could take years. Last one was 10 years before it really came back if you were invested at the top. Just maybe now's the time to change strategy a little bit. Talk to your financial advisor. I'm not one of those. 10-year Treasury. This is one that where the rates are based off of. This one is just, right now, this is 100% political. There's no read for this because we are not inflation's not coming back. We are an economy that's really receding. It's just on credit cards, and we have a Fed who intentionally doesn't, want the incoming president to do anything that looks good. So he cuts rates and makes comments the other way. But if you go out and zoom out on the interest rates, this is, going back long time. We've been on a downtrend for a while. So the only thing that is scary is if I was looking at this like a stock, this is a stock I'd buy, right? It's been downtrending for a while and it could be on its way up. And we theoretically, again, I can't tell you what would be a trigger here, but this is a terrible looking chart. And if we start clearing this number, then we start looking, let's see if I can go really far back. I don't know if I can go that far, but I will go as far as it will let me to show you like what the 80s look like. All right, zipping back in time. 77, this sort of thing, where we're 15%. Like, look at that. This was crazy. So this is where we were in 82, and we've been on a downtrend since. But this was like 15% interest rates. I don't see us going there, but the trend has been down with some dips. 2020 was the biggest, kind of drop off, and as I said, anytime you spend way under the mean, it will respond back. Like it's like a rubber band, right? We snapped so far low for so long, and now we've been here. I'd hope for some stabilization where we're just kind of hanging around here. I think everyone could deal with that, but chart doesn't look fantastic. So now you got all-time people on credit card, stock market at an all-time high, and interest rates still potentially going up. Not a good combination for more room to grow, right? Well, I don't know. I'm trying to keep my wording as good as that, not like predicting things, but this is how I'm viewing the market. So that's our 10-year Treasury. It's very similar to, if you go back, it was very similar to 07. If I can get you on a daily here so you can see it. In 07, we had the Treasury. It's a little different of a charting back here, but the Treasury's peaked up and then it kind of settled down, and then it had one more little leg up before that recession. So it's looking very similar to the time frames there. So Bitcoin, I showed you a little bit, but same sort of concept. It's been moving very much in tandem with the market. I mean, it's another avenue of investing. It's another value store, just like as gold would be, things like that. I don't speculate too much on it. I still don't 100% understand it, but chart is a chart is a chart. This could be anything. These chart patterns are the same, right? They've always followed the same. So this is really more of just a alert to pay attention to what's going on, to look at your positions financially and make sure how you doing with credit cards, how you doing, like if your brokerage account is something you have and is like a reserve account for you, like start thinking a little bit more conservative here, right? Because the news is garbage. Anything you get is not, by the time it's out there, it's already old and it's been traded on. Reading information yourself is, if the tip I have to give you to take away from this is that read information on your own, make your own decisions based on things you see, right? I saw what I saw at the mall. Then I went and did my own investigation, started looking into all these things, and that's where I'm at now. No one's going to tell you this on the news. No one's going to do this work for you. So you have to find sources that work for you. Again, outside of the news, the financial stuff is a little bit, the journals are a little bit better just to get a gauge of what's going on and then filter it with your own life. Like if you have a small business, you see demand of people before and after. Like you'll have an insight into more things than, someone who just goes to their job and has that world to live in. When you're a small business, you see like, hey, like I'm in real estate and mortgages. I see the slowdown when the interest rates go up. I see them tick up when the interest rates go down. I see the lack of inventory. You feel all that. So you feel that, and then you see, well, how many real estate agents do we have out there? And what do you think they're doing now? Their income's down. So then they're cutting back. And you see how this all plays out. The way through this without really having a bad recession is housing. Housing will save us because interest rates come down enough for people to refinance out of their $1 trillion credit card debt. They throw it into their house. Not the best thing to do, but when you have interest rates at an all-time high, clearing up that monthly cash flow is something you want to make sure you have a very low footprint, because it's about runway, right? If you lost your job today, how long can you survive on the funds that you have available, whether it's savings, whatever funds you have aside? That's your runway. There's not too many people, if you're on that much credit card debt, that have a long runway. And that's what you should start thinking about going into the new year, creating that runway of like, all right, shit hits the fan. I got 3 months. I could live the same way. I can make my emergency budget like I talked about in day one. Like, hey, if I had to cut everything, I'm at this, so I can make it 7 months, 8 months. That is the plan to have. You make your plan while times are still good, not when it's already turned. So this is just my insight into everything going on, stocks, retirement, and, I guess Bitcoin, technical analysis, overview. This is the position I have. I don't have too much in stocks. All mine is in real estate. And with real estate, it's more of a cash flow game, not an appreciation game. So see you tomorrow. We'll be talking minimalism and just, like I said, how to thin out, put some things together, and then we'll recap it on Friday, and that's it. So have a good one, guys.